Welcome to the Wealth Mentor. Have you ever pondered the million-dollar question? Or should I say, the dollar bill question? How much should you truly invest? Well, today, we're diving deep into that answer, so strap in and let's embark on this financial journey. Opening my wallet, I pull out a crisp dollar bill, the embodiment of genuine currency. Wouldn't it be thrilling if every time you tap that like button or subscribe to this channel, a Wealth Mentor dollar popped into your account? We can all dream, right? But don't rush to your local bank just yet. That's not quite how it works. Yet. Our main discussion today orbits around the universe of dividend investing. Through my journey over the past decade, I've managed to elevate my stock portfolio to a staggering $800,000. What's the secret sauce? Dividend investments. These have consistently poured around $1,500 into my coffers every month without me moving a muscle in active stock trading. When we talk about dividends, we envision them as gifts. These are periodic cash rewards companies present to their loyal shareholders. Think of it, earning without selling your stocks. And the magic doesn't stop there. Harnessing the might of compound interest, reinvested dividends have constituted a whopping 69% of the stock market's total return since the vibrant 60s. However, let's pop that rose-tinted bubble for a moment. Dividends are not your golden goose. They come with their own intricacies. While they've been a steady source of cash flow, it's pivotal to weigh their returns against other factors, tax nuances included. Yet, dividends have shown tenacity, even amidst tumultuous market waves. Take 2022. While the stock market dipped by 20%, dividend distributions experienced a rise of 10%. Stepping into the mental realm of dividend investing, one can't help but appreciate the stability they bring, especially in the face of turbulent markets. The reduced volatility of dividend stocks imparts a comforting layer of protection during market slumps. Let's now decipher the endgame for any dividend maven, creating enough passive money streams to live free, unrestrained by the conventional 9 to 5. Ever heard of the 4% rule? It's an ingenious method to gauge the funds required to taste true financial liberty. Even the investment titan Warren Buffett is a testament to the prowess of dividend investing. His stakes in giants like Coca-Cola and American Express have rained dividends, pushing his portfolio to reap dividends in the ballpark of billions. Sharing my own tale, the growth trajectory of my dividend income has been exhilarating, with some months outshining others. This year, I forecast a dividend bounty of around $17,000. But what does the horizon hold? Charting the course for the next 2 decades, given a consistent dividend reinvestment, my projections suggest a yearly intake of over $100,000 by 2043. Even if I hit the brakes on investing now, reinvested dividends alone could still net me a cool $53,000 annually by that same year. So, why the affinity for dividends over other instruments like bonds? Beyond the appealing tax landscape and favorable economic conditions, the promise of future dividend augmentations is too compelling to ignore. Yet, diversification is paramount. While dividend investing has been my North Star, it might not resonate with everyone. One thing to highlight, especially for those just embarking on their financial journey, is the diversity within the dividend realm. Not all dividends are created equal. There are qualified dividends, taxed at capital gains rates, which are generally lower than ordinary income tax rates. Then, there are non-qualified dividends, which are taxed at your ordinary income tax rate. Knowing the distinction can significantly impact your tax bill and ultimately your net returns. But what makes a company decide to offer dividends? Typically, well-established companies that have reached a certain stature in their respective industries and have steady profits choose to reward their shareholders through dividends. Newer growth-oriented companies might reinvest all their profits back into the business, eyeing expansion and innovation. It's also essential to understand the dividend payout ratio, DPR. This ratio provides insight into the percentage of net income a company pays to its shareholders in dividends. A lower DPR can indicate that the company retains a significant portion of its earnings, suggesting potential for future growth and, possibly, higher dividends. Conversely, a very high DPR might be unsustainable in the long term. Now, let's dive into dividend-focused funds. For those who don't want to pick individual stocks, there's a buffet of dividend-focused ETFs and mutual funds. These funds pool various dividend-paying stocks, providing instant diversification. Some popular funds track high-yielding stocks, while others might focus on companies with a stellar track record of consistent dividend growth. Speaking of growth, have you ever heard of dividend aristocrats? This elite group comprises companies in the S&P 500 that have not only paid, but also increased their dividends for at least 25 consecutive years. Their resilience, especially during economic downturns, makes them a popular choice among seasoned dividend investors. Another critical element of dividend investing is the ex-dividend date. This is the cutoff date for determining eligibility for the next dividend payout. If you purchase a stock before its ex-dividend date, you're in line for the upcoming dividend. Buy it on or after this date, and you'll have to wait for the next cycle. The international landscape is also rife with dividend opportunities. While US stocks might be the staple for many, diversifying internationally can offer exposure to different economies and currency dynamics. However, this does come with its set of challenges, like understanding foreign tax implications and geopolitical risks. Reinvesting dividends is another powerful tool at the investor's disposal. By opting for a dividend reinvestment plan, DRIP, you can automatically reinvest those dividends to purchase more shares of the stock. This snowball effect accelerates compound growth, which is especially beneficial in long-term horizons. Finally, for those with an environmental or ethical compass guiding their investments, there's good news. The emergence of ESG, environmental, social, and governance criteria has paved the way for sustainable dividend investing. These criteria ensure companies maintain socially responsible practices while providing dividends. Another cornerstone concept in the world of dividend investing is the dividend yield. This metric gives you a snapshot of how much bang you're getting for your buck. Represented as a percentage, it's the annual dividend payment of a company divided by its current stock price. But be cautious, an unusually high yield may be a red flag, signifying potential underlying issues with the company or that the dividend might be cut in the future. On the topic of cutting dividends, it's vital to recognize the signs. If a company's earnings consistently fall short of their dividend payments, or if they're amassing debt to maintain dividends, that's usually a harbinger of cuts to come. While dividends are an attractive feature, they're not an obligation. When faced with financial strain, companies may opt to slash or completely halt their dividend payments to shareholders. This brings us to the importance of diversifying your dividend portfolio. Just as you wouldn't want to put all your eggs in one basket in the broader investment landscape, you shouldn't rely heavily on a single stock or sector for dividend income. By spreading your investments across multiple industries and even countries, you buffer your portfolio against potential downturns in any specific area. Speaking of global diversification, dividend withholding taxes is an aspect you'll want to familiarize yourself with. Different countries have different tax treatments on dividends paid to foreign investors. For US investors specifically, some treaties may reduce this withholding tax, but it's an element that requires diligent research or consultation with a financial advisor. Now, while we've extensively discussed traditional stocks, it's worth noting that dividends aren't exclusive to them. Real estate investment trusts, REITs, are a unique investment vehicle mandated by law to distribute at least 90% of their taxable income to shareholders in the form of dividends. They provide a robust combination of real estate exposure with the liquidity of traditional stocks. Another enticing realm is master limited partnerships, MLPs, which primarily operate in the energy infrastructure domain. These partnerships often offer attractive yields, but they come with their own set of tax implications and complexities. The journey of a dividend investor also necessitates the regular monitoring of dividend coverage ratios. This metric calculates how many times a company can cover its dividend payments with its net income. Higher ratios hint at a company's ease in covering dividends, suggesting sustainability, while lower ones can be cause for concern. Given the dynamic nature of the stock market, seasoned dividend investors also tend to keep an eye on interest rates. Rising rates can sometimes create headwinds for dividend stocks, especially those seen as bond proxies due to their high yields. To sum up this extended deep dive, dividend investing, while a powerful strategy for consistent income and wealth accumulation demands an informed approach. From tax implications to portfolio diversification, there's a myriad of factors to consider and navigate. I hope this comprehensive breakdown has illuminated the landscape of dividend investing for you. Remember, the goal is not just financial growth but sustainable, informed, and resilient prosperity. Here at The Wealth Mentor, we're dedicated to guiding you on this intricate journey. Thank you for staying with me through this extensive exploration. If you appreciate the depth and insight, please give this video a thumbs up. Subscribe for more in-depth analyses, strategies, and financial wisdom.